Hey, what's up, my friend? So let me ask you, have you ever, noticed that the price is respecting a certain moving average on the chart? You saw it bounce once, bounce twice, bounce three times. So this time round is coming back for a fourth attempt for the bounce, and you are like a sniper, hunting them, waiting to get the kill. So when the price comes back and retests the moving average for the fourth time, you buy, it gets stopped out. Man, what's going on, Rayner, right? Well, I feel you, right? And this is why, you're watching my video here today, right? Exactly, right? So this is how, reminds me of my wife, right? Rayner, you can't cook for nuts, man. Exactly, that's why I married you. Yeah, so anyway, let's get started. First, let's talk about the truth behind the 200-day moving average. If you've studied, technical analysis or follow traders for a while, you'll know that a lot of them swears by the 200-day moving average, saying that this is the most important moving average to pay attention to. Both traders and investors will, give a lot of focus to this moving average. But let me just share with you, their expectations, right, when dealing with the 200-day moving average. So what you'll see is that, they will say that, the 200-day moving average is the most watched level on the charts. Look at how the price bounced off here, and here on the 200-day moving average. Well, that might be true in some instances, but in reality, right, the market rarely respects the 200-day moving average to the pip like this, right? Instead, what happens is that moving average, right, is best used in different type of trending markets. For example, reality is more like this. Let's say the market is in a strong uptrend. You are better off, right, with a moving average such as the 20-period moving average. In this case, it's this red line over here. In a strong uptrend, the 20-period moving average will be more relevant. Likewise, if the market has a deeper pullback, it's what we classify as a healthy trend, you would be better off using a 50-period moving average like this blue line over here. Okay, and of course, if the market has even a deeper pullback, right, where we classify as a weak trend, then you can use the 200-period moving average that most traders and investors, swear by. Yeah, so that's kind of like the reality of trading, right? And the lesson that I want you to take away here is this: is that there is no best moving average out there. Yes, I know the 200-day moving average is the one that gets the most talk about, right? Maybe because I have no idea why, right? But there's really no best moving average out there because it depends on the context of the market. If the market is, for example, let's say in a range, no moving average is going to, be working well, right, in such a market condition. And of course, if the market is trending like it's in a strong uptrend, then hey, you're better off using the 20-period moving average. If the market has a deeper pullback like a healthy trend, then hey, you're better off using the 50-period moving average. And of course, if the market is in a weak trend, you can stick with the 200-day moving average, right? Because trust me, right, if the market is trending strongly and you overlay with a 200-day moving average, you can wait till the cow come home, right? The price, right, will hardly retest the 200-day moving average, right? Because it's in a strong uptrend, right? It's kind of like Gandalf, right? Gandalf can wait until his beard, right, grows so long and touch the floor. The price will still not retest the 200-day moving average when it's in a strong uptrend. Does it make sense? Moving on, number 2, the truth about moving average crossover. So often when, traders hear about moving average crossover, they think that, when the moving average crossover happens, right, boom, right, you capture, massive uptrend towards the upside. It's looking something like this. So you can see over here, when the 50 crosses above the 200-day moving average, boom, right, wow, Rayner, look at this immense profit on this particular trade. So yes, that could happen once in a while, but in reality, when you try to trade the moving average crossover, what usually happens is this, right? You can see over here, numerous moving average crossover occurred over here, here, and here. You can see the market pretty much is, whipsawing up and down. So you can see that clearly right now, your reality and expectations is actually two different things, right? So for moving average crossover to work, yes, it can work, but there's one very important thing that you must pay attention to, which is this, is that you must trade many markets, right? So it's kind of like, wanting to get your wife pregnant. Are you going to, shoot once a month or 20 times a month? Of course, 20 times a month, increase your odds, right? So same thing for trading moving average crossover to ride a trend. If you want to use that to capture trends, you can't just be trading one market. You got to be trading 20, 30, 40 markets to increase your odds of capturing a trend. So the same principle applies over here. And that's not all, right? Moving average the crossover isn't just used to ride a trend, because you can also use it as a trend filter. What does this mean? This means that moving average crossover can give you a bias to know whether should you be looking for buying opportunities in the market or selling opportunities in the market. So let me give you an example. So you can see over here, this chart is the Australian against the Canadian dollar daily time frame. You can see that right now the 50 MA is below the 200-period moving average as the market on this crossover over here. So what you can do is that at this point in time, if you see this chart on the daily time frame, on Aussie Canadian, you can tell yourself that, okay, I will then only look for selling opportunities. And you can actually look for selling opportunities on the lower time frame. So for example, if I bring you down to the lower time frame, this is the 4-hour time frame, you can see that this market is in a downtrend. making a series of lower highs, lower highs, lower highs, and lower lows, lower lows, lower lows. Then again, using basic technical analysis, you know that this is an area where previous support could become resistance. And if the price goes up higher, you can look for selling opportunities right at this area of resistance. Maybe something as simple as like a shooting star pattern like this, right? And then this tells you that there is a bearish price rejection. The sellers are in control over here, and you can look for selling opportunities to see if the market continues down lower from here. So again, you can use the moving average crossover as a trend filter, right, to give you buyers, right? And of course, you can then go down to a lower time frame to help you, fine tune your entry. Number 3, the truth about the moving average bounce, right? So for example, if you overlay your chart, let's say in a healthy trend, and the price respects the 50 period moving average, many traders would think that, oh man, Rayner, the price comes to the 50 MA, bounce, comes to the 50 MA, bounce, comes to the 50 MA, bounce, right? Look how powerful, right, the 50 period moving average is, right? The moment the price touches it, boom, right, it rallies higher. But in reality, right, the market usually has a few tricks up their sleeve. So if you were to trade a healthy trend, and you know that the 50 period moving average is a useful moving average to be trading in such a market condition, here's what you can expect. You can see that the market doesn't necessarily have to respect the moving average to the exact pip, to the exact tick, right? You can see over here, it actually trades below it, and then you rally up higher. Trades below it, rally up higher. Trades below it, rally up higher. Trades below it, rally up higher. So if you were to trade this thinking that the price will bounce off the moving average to the exact pip, right, you will be sorely disappointed. So treat this, give it some buffer, treat it as an area of value, not a particular line where the market must definitely bounce off it, right? So a lesson is this, right, is that when the price respects the moving average, treat it as an area of value. You got to have, some compromise and expect that sometimes the price might reverse earlier and sometimes it might reverse later. Like how I have a happy marriage with my wife, right? I always admit that I'm wrong and she agrees with me, right? Also, another tip for you is that you can also set your stop loss a distance away from the moving average, since you know that it's an area of value, right? So for example, let's say if you were to be trading the moving average bounce like this, okay, let's say the price respects for example, the 50 period moving average, bounce off once, twice, and it comes back here and bounce up again. You don't want to set your stop loss just below this lows, because what could possibly happen is that, remember, this is an area on your chart. The price could reverse down lower, hit your stop loss, and then continue up higher, which is, pretty common as what you've seen earlier. So give your stop loss a buffer, set it a distance away from this price structure, set it a distance away from the respected moving average. So if you ask me, what I usually do is I set it a distance away from this lows, right, possibly somewhere about here. So my trade, right, has more room to breathe. So this over here, from here down to here, right, will be the distance of my stop loss SL, right? So give your trade some room to breathe. So looking back at our previous example over here, you can see over here, right, let's say there's this hammer that's being formed over here, okay, and when this market closes for the day, if you set your stop loss, imagine below this low over here, you will likely get stopped out on this pullback before the market rally up higher. So this is what I mean by, set your stop loss a distance away from the price structure, a distance away from the respected moving average to give your trade a chance to breathe. Now, if you have enjoyed this training so far and you want to learn more about such a trading methodology, called price action trading or discretionary trading, then you can get a copy of this book, right, called Price Action Trading Secrets, right? It's a 142-page, right, full color trading book where you'll discover professional price action strategies to profit in bull and bear markets. It applies whether you're a forex trader, stock trader, or even a crypto trader, right? We dive in much deeper, right, compared to what we have just covered over the last 10 minutes. We talk about area of value, support, resistance, candlestick patterns, proper risk management so you don't blow up your trading account, trading strategies, and much more, right? So go and grab a copy of it. I'll put the link somewhere below this video so you can grab a copy. We ship to almost everywhere in the world except for a few countries, right, due to logistical issues, but I think most countries we do ship it out to you guys, right? So grab a copy. With that said, I wish you good luck, good trading. I will talk to you soon.